Are you one of the 500,000 to 600,000 people in Ireland that have a mortgage right now? If you are, it's probably crossed your mind at some point, if you've had a bit of extra cash, whether it is a good idea or not to try and pay it down a little bit faster. As with any type of debt, it can feel like a bit of a burden sometimes, and it is understandable if you want to try and get rid of it as soon as possible. But in this video, what I want to do is go through 4 different things that you should think about before you even consider paying off any of your mortgage a bit faster. But this is not financial advice in any way, it is just to get your mind jogging. If you are planning on ever paying down your mortgage a bit faster, please make sure to contact your financial advisor and your bank especially before you ever do it. Everybody has their own different individual needs and different circumstances. That is why they call it personal finance. So just take this as a bit of a guide and nothing else. So first on my list is there any other better use for the money that you are planning to use to pay down your mortgage a bit quicker? The first thing you should consider is, do you actually have an emergency fund set up? So an emergency fund is set up to deal with any types of unexpected situations like losing a loved one, losing your job, for example. If you do not have an emergency fund set up, which is typically 3 to 6 months of your monthly expenses that you need to live, then you probably have no business in trying to pay down any of your mortgage a bit quicker. Firstly, you should definitely be considering setting up an emergency fund. Another very important one to consider is, have you maxed out your pension contributions? Because in Ireland there is pretty favourable tax treatments for any pension contributions that you make. Basically, you can save 40% tax on any income that you have made that you have put towards your pension up to certain limits. Basically, you can get €100 benefit towards your pension with just a €60 contribution, and that is then going to grow tax-free until your retirement. So that is definitely one to check out as well before you go and pay down your mortgage any bit faster. Next up, is there any type of investment or deposit account where you could possibly earn a greater return than the interest that you are paying on your mortgage? Your mortgage is probably going to be the cheapest loan that you will ever get. Most people will be paying a rate at somewhere between 2.5 to about 3.3%. If you can consistently beat a return of 3.3% every year after tax, then your net wealth is obviously going to be a lot better off than if you use the cash to pay down your mortgage. But that may be a lot easier said than done, because you also will have the risk that you could lose money as well when you do start investing. Another very important one to check out is if you have any other debts with much higher interest rates than your mortgage. So many people might have an overdraft or a credit card debt, and that can have a rate of interest of like 15 to 22 or 3%. So it makes much more sense to try and pay down those types of high cost debts down first before you go tackling your mortgage. Your next important consideration is whether you are on a fixed or a variable rate mortgage. So there will be limits depending on which one you are on. On a variable rate mortgage, you can normally just pay off as much as you want and you don't really have to worry about anything. But if you are on a fixed rate mortgage, then normally some limits will apply. Let's have a look at some of the most popular mortgage providers in Ireland at the moment. Say for Avant Money, you can pay off up to 10% of the balance of your mortgage in 1 year as an overpayment in 2 installments. For Bank of Ireland, then you can overpay 10% of your usual monthly repayment, or €65, whichever is greater. AIB, however, have much less favourable terms. If you pay off your mortgage earlier or you change your interest rate on your mortgage throughout your term, then you are likely to face some sort of breakage fee. So you definitely need to check with your bank before you ever make any type of overpayment, just to be sure that you never get caught with any of these types of fees. Next up, if you are allowed to either make a top up on your monthly repayment or go with a lump sum, you're going to have to decide which one is actually better for you. So the best way to possibly compare these scenarios is with an example which I've just done up here. So let's say in this example, the Ryan family, they have $110,000 left on their mortgage, and there is 15 years of a term left on it as well. And they currently have a variable interest rate of 3.51%. So let's say if we went and had a look at what the effect would be if they decided to pay off a few lump sums off their mortgage. So for a €5,000 lump sum, that would save them €2,900 in interest and reduce the term on their mortgage about 1 year. If they went with a lump sum of €10,000, they would save €5,600 in interest, and it would reduce the term of their mortgage by 1 year and 8 months. A €15,000 lump sum would save them about €8,000 in interest and about 2.5 years on the term of their mortgage. And finally, a €20,000 lump sum would save them about €10,500 in interest and about 3 years and 3 months off the term of their mortgage. If we then compare that to a situation where they just decide to increase their monthly repayments, so a €50 increase on their monthly repayment would save them interest over the term of their mortgage of €2,293, and that would save them about a year and 1 month off the term of their mortgage. If they increase their monthly repayments to €75, then you're looking at about $3,300 in savings of interest and 1 year and 7 months off the mortgage. And if we look down through the rest of the list, then a €200 overpayment will save them about $7,000 in interest and about 3 years and 8 months off the term of their loan. What we notice really from this example is that a lump sum is going to give you a bigger hit and quicker savings on your interests, but you can achieve an equivalent reduction in your term by increasing your monthly repayments also. There are lots of different calculators online. I'll leave a link to some of them below in the description section if you want to run the numbers on your own situation to see how lump sums and overpayments actually affect your interest savings and the term left on your mortgage. The goal of most people will be to reduce the overall term of your mortgage, but what you will have to do is actually, when you do make, say, a lump sum, for example, on your mortgage, you will have to inform your bank whether you want to either reduce your monthly payments from then on or else reduce your term of your mortgage. Most people obviously will go with reducing your term, but with a lump sum obviously you can keep the same term of the mortgage and then reduce your monthly payments until the end of the mortgage. So that might suit people as well. So that's pretty much it for my video today. Thanks for joining me on my walk. I hope you could hear me with all the wind. If you like this kind of content, then please make sure to subscribe to the channel and drop a like on the video.